Welcome to our third lecture for week 8, chapter 9, net present value and other investment criteria. Next, to look at how the time value of money, moving money back and forth in time, discounting and compounding, can be used in the analysis of financial data and in the selection of projects. And this is really getting to the core of some of the important decisions that you'll have to make, especially in your course project. The idea here is that once you understand the time value of money concepts, you can apply them in decision methodologies for project selection, capital budgeting, things like this. So, take a look first at the capital budgeting process. The first decision that's made is what's the capital structure. We then consider the cost of capital. We go into the capital budgeting process, which then yields certain profits or losses, and then that determines our dividend policy. We're going to look at a little more detail around the capital budgeting process, how it works, some of the key decisions that are going to be made. Capital budgeting is basically suited to 4 types of decisions. If we look at replacing equipment, we can do it for maintenance needs or for obsolete equipment, or we can do it to reduce costs. If we're looking at expanding equipment, we're looking at taking on an expansion of a current product or current service, in other words, just making more of what we've already got, or venturing out into a new product or to a new service. So these are the 4 basic questions that the capital budgeting process seeks to answer. When we look at some timelines around different forms of financial instruments, for example, a bond, a common stock, and a project, you see that the bond has coupons, which are an annuity, cash flows. You see common stock pays dividends on into infinity as long as you own the stock. And a project has initial costs and then cash flows. All 3 of these have identified future dollars that must be considered. All 3 involve bringing future dollars into present value terms. And all 3 involve an accept-reject decision in the form of purchasing or not purchasing the entity. A bond has coupon payments and a lump sum payment at the end. A stock has dividend payments forever, while projects have cash flows that end at the end of the project. Coupon payments for bonds are fixed. Stock dividends change or grow over time, or they may diminish. Project cash flows are typically different each year depending on the economic conditions and the progress of the project. With bonds and stock, our goal is to determine the value today. Our goal with projects is to determine if we will exceed our costs with the cash flows identified. And for you as an environmental manager, if you're going to be involved in projects, especially if you're in a consulting role or perhaps an internal manager role, if you're going to take on a project, say buying a new set of equipment or even undertaking a project at a client site, the fundamental determination you're going to make is will the cost of the project be greater than the revenues from the project with the cash flows we've identified? That's a critical distinction. And managers will be looking to you to provide an answer. Our core task to determine if we should purchase the project, or should we undertake the project at all, or should we just leave it? And how are we going to accomplish this? How are we going to make determination? This is our acronym for the day. Bring all expected future earnings into present value terms. This is how we do it, and this is the only way that makes sense, as we'll soon see. So just remember this little acronym. I'm not sure that you will remember it, but do your best. So, payback. How do we determine payback? And what is payback? Payback period is how long it takes to get the initial cost back in a nominal sense. It's a very commonly used figure for many organizations for projects. We compute it very easily. We estimate the cash flows. We subtract the future cash flows from the initial cost until the initial investment has been recovered. Here's an example. You're reviewing a new project and you have estimated the following cash flows. Cash flow year 1, negative $165,000. year 0 negative cash flow year 1, with the net income again 13,620. Year 2 net income 3,300. Year 3 net income 29,100. Average book value at the end of the project 72,000. So your required return for assets at this risk level is 12%. Question, because do not take into account the risk level. So what we do is we take a look at the initial cash outlay, and we say, okay, cash flow in year 1. We subtract that from the initial outlay. We get 101,880. Cash flow in year 2, we keep going, subtracting it from the amount we just arrived. We still have a positive. So we need to get to 0. So we keep. Year 3, we have 31,080 minus 91,080 cash flow in year 3. We pass to 0, so payback is achieved. We have paid back the original amount we put out for the project. So what's the decision? Do we have a deal or no deal? We need to know management's number. In other words, what does the firm use for the evaluation of its project when they use payback? And most companies use either 3 or 4 years, so let's use 4 for example. Our computed payback was 3 years, a little over 3 years. The firm uses 4 years as its criteria. So yes, we accept this project as recover our cost of the project early. So payback technique is in units of time, and we accept if the payback period is less than management's cutoff period. We need to ask ourselves, though, some questions about our decisions that we're making as part of the capital budgeting process. And when we evaluate capital budgeting decisions, the different approaches, the different decision methods. First of all, does the decision rule adjust for the time value of money? Does the decision rule adjust for risk? And does the decision rule provide information on whether we're creating value for the firm? These are the 3 important questions. These are points that you can use to argue if your firm is stuck on one method and refuses to consider another method. For example, if your firm is using payback and doesn't really want to use net present value. So let's look at payback. Does the payback rule account for the time value of money? No. Does the payback rule account for the risk of cash flows? No. Does the payback rule provide an indication about the increase in value? No. Should we consider the payback rule for our primary decision rule? No. And your managers may not want to. So if payback's not that great as a capital budgeting technique, well, why are we using it? Why is it so popular? Well, because it's so easy to compute. It's very simple. And that really is its core benefit. It's easy to see, easy to understand. So it's easy to understand. I mean, adding and subtracting. You can adjust for uncertainty of later cash flows. However, it's biased toward liquidity, which is a positive thing. We like liquidity when it doesn't detract from long-term assets. However, payback does ignore the time value of money, requires an arbitrary cutoff period that may not be realistic. Also ignores the cash flows beyond the cutoff date, and it's biased against long-term projects such as research and development and new projects. And if you're involved in any scientific projects, you'll know that this method, the payback method, will frequently shut you out because it doesn't really take into account some of the longer-term benefits that you may be realizing. So discounted payback is our next method. What is discounted payback and how does that work? How long does it take you to get to the initial cost back after you bring all the cash flows to the present value? So we are now introducing discounting. So what we do is we estimate the present value of the cash flows, subtract the future cash flows from the initial cost until the initial investment has been recovered. So we've estimated here, you can see, we've estimated the present value of all the cash flow. So we subtract year 1 from the present value of the cash flow from year 1 is year 0 minus the present value of cash flow 1. So we have year 2, we subtract that figure. We subtract the discounted value of cash flow in year 2, 56,441. We still have a positive value. In year 3, we subtract the discounted value of the cash flow. So we end up with a negative value, so we're finished. So a discounted payback period, the units again are time, and we accept again if the payback is less than management's arbitrary cutoff. So let's look at our criteria. Does the discounted payback rule account for the time value of money? Yes. Does the discounted payback rule account for the risk of the cash flows? Yes. Does the discounted payback rule provide an indication about the increase in value? No. Should we consider the discounted payback rule for a primary decision rule? No. So what's next? We can look at it. It does have some advantages. It includes the time value of money. It's easy to understand, and again, it's biased towards liquidity. But it really, again, it has some significant disadvantages. It requires an arbitrary cutoff point. It ignores the cash flows beyond the cutoff point, and it's biased against long-term projects, such as R&D and new projects. So what are we left with next? Okay, let's look at net present value. Net present value is the difference between the market value of a project and its cost. This is a very important definition, the difference between market value and its cost. So how do we determine that? We estimate the future cash flows, we estimate the required return for projects of this risk level, and we find the present value of the cash flows and subtract the initial investment. So it means net. It's net of initial investment at present values. A positive net present value means that the project is expected to add value to the firm and will therefore increase the wealth of the owners. And so, since our goal is to increase owner wealth, net present value is a direct measure of how well this project will meet our goal as measured in dollar terms. So here's our timeline again. This is our example. We can take a look at step 1 in computation. We, again, discount the cash flows back to the present day. We end up with the present value of all cash flows. Step 2, we subtract the present value of inflows, the present value of outflows from the present value of inflows. So we start with the present value of the cash flows discounted to present day. Minus 165,000, we see that the net present value is 12,627. So if the net present value is positive, greater than 0, then we accept the project. Conversely, if the net present value is negative, then we reject the project. And thus, in our case, the net present value is 12,627, so we accept the project. So our net present value technique looks at the units of dollars, and we accept if the net present value is greater than 0. Does net present value pass our decision criteria test? Does it account for the time value of money? Yes. Does the net present value rule account for the risk of cash flows? Yes. Does the net present value rule provide an indication about the increase in value? Yes. And should we consider the net present value rule for our primary decision rule? Yes. Net present value has a number of advantages. It considers all the cash flows in the computation, even though in this particular case we only went out 3 years. Uses the time value of money and provides an answer in dollar terms, which is easy to understand. It usually provides a similar answer to the internal rate of return computation unless there's significant difference in market conditions and the conditions inside the firm. The disadvantages of net present value is that it's a little bit more difficult to compute. It requires a certain set of calculations to be performed, and they're a little bit difficult. And the major disadvantage is that projects that differ by orders of magnitude and cost are not obvious in the net present value final figure. You could have a project that has $10 million a month in cash flows and a project that has $100 a month in cash flows. And the projects could both have the same net present value, but it really wouldn't tell you that much about the scope of what the effort is that's required for each project. So profitability index. This is another area where we can look at profitability index measures the benefit per unit cost of a project based on the time value of money. It's very useful where you have multiple projects of hugely different costs or limited capital, known as capital rationing. The computation is very simple. It's a present value of inflows versus as a numerator over the present value of outflows as denominator. So what's that ratio? Here's an example. This is our equation. If we have $177,000 present value of inflows, $165,000 present value of outflows, which is in our last example, we have a profitability index of 1.0765. So what does this mean? It means that for every dollar of investment, we create an additional $7.0765 in value. A profitability index greater than 1 means the firm is increasing in value. So this is a very important a very important figure because it looks at kind of the scale of the net present valuation. So the units are really none, it's just a ratio. Won't we accept a project if the profitability index is greater? It's closely related to NPV. It's generally leading to the same decisions you would make using a net present value analysis. It's relatively easy to understand and communicate. And it may be useful when available investment funds are limited. You're trying to look at what exactly, where is the return on these different areas, and where can we get our greatest return. It may lead to incorrect decisions, though, if you're comparing mutually exclusive investments, because it doesn't include indications of scale and changes in capital structure. So we have a couple of other forms of project evaluation: the average accounting return, internal rate of return, modified internal rate of return, and then we look at overall how these all fit into the practice of capital budgeting. So let's consider for a minute the accounting return. The average accounting return is a measure of the average accounting profit compared to some measure of average accounting value of a project. And the average accounting return is then compared to a required return by the company. So it's average net income over average book value. So we take into account the value of the project. So let's take a look at our example again. We have a new project. We have estimated the following cash flows. This is the same example as we did. Using the figures of our previous example, we come up with the average accounting return of about 21%. So if we compare this to our firm's requirement of 25%, we would then reject this project as the average accounting return is less than 25%. You can see the details of this. I'm not going to go into a lot of detail on this. You can read about it in your text because I really want to focus on net present value and internal rate of return. Not many companies use this. So if the average accounting return in percentage is greater than management's number, and then we would accept. However, the average accounting return has a lot of weaknesses, which is why it's not widely used. Does the rule account for the time value of money? No. Does the average accounting rule account for the risk of cash flows? No. Does the AR rule provide an indication about the increase in value? No. And should we consider the AR rule for our primary decision rule? No. So it's one of many methods. It is easy to calculate, and you usually can get the information. But it's really not a true rate of return because the time value of money is ignored. It uses an arbitrary benchmark as a cutoff rate. And it's based on accounting net income and book values, not cash flows and market values. So it's very internally focused and may not reflect reality. So let's consider the internal rate of return. This is a very significant alternative to net present value. In fact, internal rate of return and net present value should be your two primary decision factors. It's often used in practice. It's intuitively appealing. And it's based entirely on the estimated cash flows. It's really independent of interest rates found elsewhere, so it's internally focused. The internal rate of return is defined as the discount rate or required return that will bring all the cash flows into present value time and total the exact value of the cost of the project. So it's when the net present value is equal to 0. It's the return that will yield a net present value of 0. So what is the discount rate that yields a net present value of 0? If the internal rate of return of a project is greater than the firm's cost of capital, then we would accept the project. For example, if a firm can borrow money at 5%, but yet the internal rate of return on a project is 10%, we would pursue the project rather than borrowing money. Since our goal is to increase owner wealth, the internal rate of return is a direct measure of how well this project will meet our goal as measured in interest rate terms. So the internal rate of return is in units of percentage, and we accept if the IRR is greater than the market rate or the best rate available in the commercial markets. The decision criteria test, does it pass? Does the IRR rule account for the time value of money? Yes. Does the IRR rule account for the risk of cash flows? Yes. Does the IRR rule provide an indication about increase in value? Yes. And should we consider the IRR rule for our primary decision criteria? Yes. In fact, first situations, or the first two criteria we would look at would be, or the first two methods we would look at would be net present value and internal rate of return. Internal rate of return does consider all the cash flows in its computation, uses a time value of money, and if the IRR is high enough, you may not need to estimate a required return, which is often a difficult task. It usually provides a similar answer to the net present value equation. However, it uses the firm's required rate of return for comparison purposes, which may not be a realistic assumption. Unusually high numbers can often occur when a significant amount of the project's cash flows occur early in the life of the project, so it can be biased towards short-term projects. Mutually exclusive projects are very common, and if in a mutually exclusive project situation, if we can't choose one, you must choose the other, and vice versa. If you choose one, you can't choose the other. So, for example, you can choose to attend graduate school at either Harvard or Stanford, but not both. Intuitively, you would use the following decision rules. You choose the project with a higher net present value and choose the project with a higher internal rate of return. So what about this situation where we have positive rates of so we have positive net present values and we have high rates of returns. If both projects are of equal risk, which project would you select? Then the question becomes, what are the changes required in terms of capital structure and dividend policy and other impacts on different parts of the organization in order to undertake those projects, because the financial analysis is inconclusive. What we have here is what we call something called a net present value profile, and we have something called a crossover point where the internal rate of return for A and the internal rate of return for B are graphed, and we have something that it's indifferent. If what we see is that if we go by the discount rate, and the discount rate is less than the center point, then we would tend to choose project B, actually project A, because it has a higher net present value. But if we go above the center point, the indifference point, we would tend to choose project B because it has a higher net present value. So what we look at here is we're plotting net present value versus internal rate of return for the projects. This gives us a way to choose between internal rate of return and net present value. Don't worry about calculating these. Just be aware that you can look at these two and you can provide more or less a correlation between them, so that you can use this graph to select what they call a crossover point or an indifference point in the net present value and internal rate of return. Net present value and internal rate of return generally give us the same decision. The exceptions are when the cash flows are unconventional. The cash flow signs go up and down. They change more than once. And then for mutually exclusive projects, the initial investments are substantially different, and we have issues of scale and other issues related to what's necessary structurally to undertake the project. And then when the timing of cash flows is substantially different. Net present value directly measures the increase in value to the firm. So whenever there's a conflict between net present value and another decision rule, you should always use net present value. The internal rate of return is a good figure for reference, but again, it uses estimates of what management requires, which may not be realistic. It depends on how tuned in they are to the markets. It depends on the credit rating of the company and other factors. So net present value actually is overall the most accurate determination of whether or not a project should be undertaken. So the practice of budgeting, how does it work? The idea is that we should consider several investment criteria when making decisions. Many managers will be using the techniques of capital budgeting as part of their job. You may get involved with this, so it's good for you to be exposed to it. Payback is a commonly used secondary investment criteria and used when project costs are small. But the net present value and internal rate of return are most commonly used primary investment criteria, and especially when you're talking millions and millions of dollars, because the impacts of small changes are very significant. This is a rather interesting ethical issue. Should a firm exceed the minimum legal limits of government-imposed environmental regulations and be responsible for the environment, even if this responsibility leads to a wealth reduction for the firm. So is environmental damage merely a cost of being business that's being externalized? Since we're speaking to the preaching to the choir here, you probably say, yes, we should take on these costs. However, it's important to understand the financial impacts of these. So let's assume that to comply with the Air Quality Control Act of 1989, the company has to install 3 smokestack scrubber units at $355,000 per unit. An estimated $100,000 per unit in fines could be saved each year over the 5-year life of the ventilation stacks. The cost of capital is 14% for the firm. The analysis of the investment results in a net present value of negative $35,076. So we're looking at here a healthier working environment. Could the investment in this healthier working environment result in lower long-term costs in the form of lower future health costs? If so, might this decision result in an increase in shareholder wealth? Perhaps we need to consider some side benefits. And actually, this is what the problem is that we're looking at in the threads this week, the forestry problem. This is how I would like you to look at this problem, because it really is not only financial, it's also ethical. So just be aware that the financial decisions have important ethical consequences, and the exchange rate or the translation rate between financial results and operational results many times is a set of ethical criteria that have been derived from philosophy and ethical reasoning. So our terminology: understand capital budgeting, our decision criteria, the project's cash flows, payback period, discounted payback period, net present value, internal rate of return, modified internal rate of return. We didn't cover that, but so in summary, our payback criteria is a period in which the initial investment is recovered. It's the length of time until the initial investment is recovered. Take the project if it pays back within some specified period, but it doesn't account for a time value of money, and so there's an arbitrary cutoff period. The discounted payback period is the length of time until an initial investment is recovered on a discounted basis. And again, we take the project if it pays back in some specified period, and then again we have an arbitrary cutoff period. Our net present value is the difference between market value and cost. When we take the project, if the net present value is positive, it has no serious problems, and so this is our preferred decision criterion. The internal rate of return is the discount rate that makes the net present value equal to 0. So we take the project if the internal rate of return is greater than the required return. It's the same decision as net present value with conventional cash flows, but it's unreliable with non-conventional cash flows or mutually exclusive projects. Our profitability index, again, is a benefit-cost ratio when we take our investment if profitability index is greater than 1. But it cannot be used to rank mutually exclusive projects, and may be used to rank projects in the presence of capital. So what are the most important topics of this chapter? Capital budgeting techniques basically involve comparing anticipated cash flows to that of a project's cost. Payback and average accounting return do not utilize the time value of money, whereas net present value, internal rate of return, and modified internal rate of return are superior to other techniques, and these should be the primary decision criteria that you use when selecting a project. The profitability index assists with the evaluation of unequal costing projects, but all projects may not have identical risk classifications, and we can adjust these using a risk-adjusted discount. So if you have any questions on this, please post them in the Q&A threads. Otherwise, we'll see you in the class shell.